Good morning, everybody. If we could get started, please, because this panel lost 10 minutes to the return of Iran to the market. So the subject of this panel is technology developments for strategic advantage, but in fact it's become, in its iteration, far more a discussion of how can technology assist bringing supply at a lower cost, and can technology evolve in the time frame that we see, which is very similar to what Sadat just said, before the oil price takes over again. And let me tell you that the service companies will not hesitate to raise their prices as soon as activity improves. So the three questions are the role of technology in reducing break-even levels. Will the US experience accelerate shale developments in the rest of the world? And will the industry suffer a skills gap when growth returns as a result of the current layoffs? There are a lot of questions surrounding the future of shale, both in the US and overseas. I've listed some here. And we're very fortunate to have Mark Papa, the former chairman and CEO of EOG Resources, who's now with Riverstone, but has been dubbed by some to be the king of shale. So, and then we have Kevin from Precision Drilling, who will discuss some of the technology, and Ashok from Schlumberger, who will look at the worldwide situation. Personally, I'm very much of the view that this is not just a shale issue, it's a worldwide issue. And that decline rates, given the current oil price and the current cuts in expenditure we've heard about, are such that we need to worry about the whole supply equation and not just the shale. And that personally, I have the view, which Ashok may contradict, that technology can't evolve fast enough to improve the cost significantly in complex and deep water before the oil price returns. And I think that OPEC can only support a low price for both financial and technical reasons being the need to reinvest for a relatively short period of time. I would just like to say something about the skills gap. Actually, I was very struck by what Helge Halderson said about E&P 2.0, because like all software releases, it requires a new generation to really make them work properly. And I think that one of the issues that this industry has is that it's getting grayer and grayer, and we would probably, though it's very difficult to effect, do well to renew a great deal of the people who are used with the working of the tools and the technology of a new generation. If you want to sum that up in a phrase, it would be that you don't win wars with peacetime generals. And I think it's probably time that the crew change actually happened. And I know that presents all sorts of problems with experience, but with technology, I think you can go a long way today to mitigate that. And it really probably is time that this generation, my generation, handed the industry over to a younger group. Mark, would you like to talk about shale?
Thank you, Andrew. Yeah, the expertise that I can hope to bring to the people in this room really relates to what is likely to happen to United States shale oil production over the next few months and also the next few years. And so I will try and concentrate on that and then make a few comments at the end relating to some of the points Andrew mentioned relating to the role of technology and also the crew change in terms of generational issues. But first, let me see, bring to the slide here. This first slide indicates what's going on with crude oil production in the United States. And this is not just shale oil, this is total crude and condensate production in the entire United States from 1970 through today. And most of you are familiar with what's going on here. I picked 1970 because that was the year where crude oil production in the United States peaked when the North Slope of Alaska production came online, brought production up to about 10 million barrels a day. And if you look at that chart and generally just kind of eyeball it, you'll see that from 1970 until about 2009, production fell from 10 million barrels a day to 5.5 million barrels a day, and just kind of a gradual sloping decline. And up until 2009, most forecasters kind of expected that U.S. production would continue to decline, and we'd have a greater dependence of imports as we went on into the 2015-2020 timeframe. And then boom, the shale oil revolution hit, of which EOG Resources was kind of the leading light there. And all of a sudden production jumped dramatically from 5.5 million barrels a day up to a peak of about 9.6 million barrels a day in almost instantaneous fashion in terms of what we're used to in looking at things in geologic time. So no surprise, you put another 4 million barrels a day in the global market, and that was more than global demand could stomach, and oil prices consequently fell dramatically. What's of more interest, however, is what has happened to United States production in the time frame that oil prices have fallen. And so what I've done here, and I'll have apologies to Adam Szyminski, who I noticed is in the audience here. I've done some extrapolations. Adam, of course, heads the EIA, Energy Information Agency of the Department of Energy. I've taken the data on the rate of U.S. oil production growth since June of 2012, which is a reasonable time frame, and I've kind of broken it down, put it in graphical form, and then the dotted lines on the right here are an extrapolation of what I expect is going to happen over the next several months to the rate of U.S. oil production growth. And this is not only the shale oil, this includes the Gulf of Mexico, this includes all production in the United States. And I think what I'm about to tell you here is something that is perhaps a little bit surprising piece of data, and that surprising piece of data is that we're about to see a pretty dramatic decline in U.S. production growth, in fact, a reversal of U.S. production growth, and it's happening literally as we speak right now. What this chart shows is that the rate of U.S. production growth since June 2012 was fairly constant at about 1.1 million barrels a day year-over-year growth during most of this period until the last few months. And then you can see that that curve is broken over and is declining now. The last few months, the last 2 months have shown a production rate growth of only 600,000 barrels a day year over year. What I expect to see, and this is based on the experience that we kind of generated at EOG and just the lack of capital investment, particularly in the shale plays, is that for the calendar month October, which is this month, which will be reported December 31st by the EIA, that the year-over-year production growth in the United States is likely to end up at zero. In other words, growth will cease and desist, if you will, in the entire United States, and that by January, that growth, which will be reported by March 31st, that growth is going to turn negative to the tune of about 700,000 barrels a day negative growth. So we're going to see a very rapid reversal in the rate of growth of United States production. And this obviously has significant consequences in the global oil market. If you look at this in kind of a more significant kind of a 30,000-foot view, at current oil prices, $45 WTI, I would submit to you that there are no significant domestic oil plays that are economic on an all-in, full-cycle basis. And the other points on this slide here just really reiterate what I've mentioned to you, that domestic production growth is fixing to stop completely literally this month, and it's going to reverse very, very soon. So what does that really mean, and what are some other consequences of that? Some other global factors I would put in there, first of all, is I would say that it's going to take a price of somewhere in the range of $80 a barrel to get U.S. production growth to grow again. The second point, and this is a very important point, likely no shale oil outside North America for 5 to 10 years. It's no secret that for the last 5 or 6 years, every E&P company, from the largest integrated to some microcaps, has been looking to find economically successful shale oil outside North America unsuccessfully to date. And I would posit that that lack of success is going to continue. So there's not going to be supply sources coming on outside North America in terms of shale oil. On the technology point, a lot of people like to extrapolate technology and say it's going to lower the break-even point, down to very, very low levels. Running an E&P company for 15 years, as I've done, I would agree with a comment Andrew made earlier that it's very unlikely that technology is going to continue to lower the break-even point of oil such that we're going to have a sustained low oil price on a go-forward basis. And on the skills gap issue for workforce, I think because I believe this oil price downturn is going to be a relatively brief duration, I really think it's only going to have a modest impact on the skills gap workforce issue. So just closing with my comments, I would say the following. My expectation is global prices are likely to rise in 2016 as U.S. production backs off. Non-OPEC production outside the U.S. also is likely to fall. I would say that it's kind of a Goldilocks scenario as to where a price is going to go. If prices go back up to $90, $95, that's going to stimulate too much U.S. shale oil production. On the other hand, $45 is too low, so if 90 is too high and $45 is too low, kind of Goldilocks. Maybe $75 is just right. So those are the comments that I would offer in relation to this panel. Thank you.
Thank you, Mark. Kevin.
Mark, thank you. I think Mark did a very good job helping us understand the potential decline and fall of the shale empire. I'll talk a little bit about how the empire was built and what it takes to build a shale empire. And I think it should be surprising that the largest or fastest growth production in the world over the last 5 years came from one of the highest cost sources of hydrocarbon in the world. So I think that's in itself interesting that we saw that growth in the highest cost curve oil in the world. I've been involved in shale oil and shale gas development from a technology and service perspective for about 20 years. And as a land drilling contractor, understanding this phenomenon is really important to the strategy of my company and how we manage the cycles. But Andrew, to answer the question of will the U.S. experience accelerate shale developments in the rest of the world, I think the short answer is that it's a very low likelihood with many, many hurdles. But to understand the question fully, I think we need to consider how in the U.S. the geology, the technology, the infrastructure, the commodity prices, and the capital markets all conspired or aligned to mitigate those hurdles and incentivize North American growth. And I would agree with Mark's supposition that there's likely no growth outside North America for at least 5 or 10 years, and I'll kind of walk through how that might happen. But I think it's helpful to understand shale and think about it going through 2 phases. And the first phase is an exploratory or de-risking phase, and the second phase I call a full-scale development phase. And the de-risking phase in North America was conducted primarily by smaller companies that were nimble, agile, didn't have high internal cost structures. They could make decisions quickly and move into the shales and de-risk those shales. They could find the sweet spots and they could prove the economic viability, Mark being one of the largest players in that space. We know the construction of a horizontal shale well is quite high, but we also know the capital was recovered in a very short period of time when the commodity prices were strong. So made for an attractive investment. And the tight geology demanded very close well spacing to optimize the drainage, and the sharp decline curves demanded an accelerating drilling program to continue to grow production. And as full-scale development emerged and production rose, that treadmill continued to accelerate, and so did the need for capital. So America progressed through a capital-intensive, de-risking development cycle in less than 5 years, and that's really remarkable. I want to examine the hurdles, and let's see here, catch up on the slides for a moment. Good. I want to examine these hurdles, and I try to explain how this all came together. But on the technology front, the technology was developed and de-risked really in the 1990s by George Mitchell. He proved that drilling a horizontal well into tight formations, injecting large volumes of sand, could unlock the hydrocarbon. And I think by 2010, that technology and completions technology was mature and optimized. I think that the Macondo event in the Gulf of Mexico was a huge catalyst. I think it pulled a number of large E&Ps on land in the domestic U.S. and applied capital and attention very quickly to Eagle Ford and later the Permian. But ultimately, like most energy frontiers, it comes down to a question of capital. And I think the existing infrastructure of pipelines, of roads, equipments, and importantly, energy services really facilitated and allowed that early development of tight oil to occur in a capital-light environment. And that seed capital wasn't really needed to accelerate or start the shale revolution. However, that early production that came on began attracting outside capital, and the production surge attracted yet more capital. In fact, the conventional valuation metrics of reservoir and production were replaced by growth-based valuations. Equity capital became very cheap. Quantitative easing created very expensive debt capital. By our estimates, about $300 billion flowed into North America through outside capital funding, and that combined with about $1.2 trillion of reinvested cash flows. So $1.5 trillion invested over a 5-year span. And that large-scale, readily available, inexpensive capital is what truly accelerated shale production growth. Now, the investors demand capital efficiency, and the best way to do that has been through reducing the cost by reducing both drilling times and cycle times. And the E&P operators responded by utilizing scale and moving to large-scale operations, or actually industrializing the process. So just a quick look at industrialization. Industrialization is all about lowering the cost through scale. And manufacturing technology underpins industrialization, but it really is about the process steps, cutting cost, measuring, improving, measuring again, and applying lean throughout to reduce waste. So the concepts of consistency, predictability, repeatability, cost efficiency, and scale pervade all planning on large-scale type shale opportunities. So to move to what's happened to the drilling side particularly, we can see two effects of this industrialization of technology. We can see that in the example I'm showing here in the Montney, which is a Canadian deep basin gas play, we've reduced drilling times about 28% through our hold depths 28% longer through the application of technology. But we've in fact reduced cycle times by almost 40% through industrialization, the application of scale. And this combination of a 60% reduction in drilling cost is exactly how shales are going to be developed long term. If I turn to the Barclays CEO conference back in September, virtually every single operator put up a slide around their efforts to improve scale, reduce cost, drive economics, shorten cycle times. And the messaging of industrialization was not lost on anyone. Now, it wasn't laid out in those terms, but clearly the message was consistent across the wide span of shale operators in the US. I do think that the discussions around pricing and pricing of services are ephemeral at best. Our services right now, generally at spot pricing, are being sold below investable levels. So these levels can't be sustained. So those that are building their economics in a long-term reduction in service prices are in error. The industry is going to be undercapitalized and will not be able to support the growth. So turning back to the question that I answered at the beginning about will the shale experience accelerate developments in the rest of the world? The geology exists. We know there's geology in China, Poland, Germany, France, the UK, Saudi Arabia, Argentina, to name just a few. So the geology is going to be, if anything, it'll be an incentive for development. From a technology standpoint, we have the technology. There should be no question about that. It certainly is going to incent development. I think a catalyst event is much tougher to handicap, and it can go either direction for us. A catalyst could be a fracking ban, which blocks development, or a catalyst could be a shock to supply that could cause shale development. But I still see the real challenge here being capital intensity. And most non-North American opportunities don't have the installed infrastructure to get the de-risking phase to occur. And the combination of high commodity prices, quantitative easing, multiples that we experienced in the US over the last half decade may not repeat themselves. So I rate the likelihood as quite low. Rate it difficult to get through the first phase of de-risking, and just move back, and unlikely to commercialize in the short term. I'll just finish up, Andrew, on the question about the workforce aging and losses during the downturn. Back when this topic first came up in the early 2000s, I thought it was part of the solution at 40 years old. And just a few years later, you're saying I'm part of the problem now. But seriously, I think this industry has faced a challenge a number of times through the cycles. I think those companies that understand the importance of human capital and talent will do fine, and I think others will struggle. But I think the industry as a whole will manage its way through the workforce transition. On that comment, I'll pass it over.
Ashok.
So I'm going to go to, I'm going to skip through some of the slides because both Mark and Kevin have covered quite a bit, and Mark covered very well how the decline is sort of imminent and is, in my words, becoming evident by the end of the year, will be quite evident to everyone. Now, and to broaden this question, when we go through a regime of low prices as we are going through, always the production replacement challenge or the decline rates comes in or it looms up in front of us. And the way we characterize it right now, looking at the different resources that give us our production from all over the world, the 94 million barrels that are produced. If you look at all of them and look at the different decline rates that all of them have, then every year we have, the industry actually has to add production to the tune of, say, 8 million barrels, or maybe even more than that. Even though the demand grows by 1 to 1.5 million, we are actually replacing that much production every year. And so when you look at capex reductions of 25, 30%, then you are obviously going to go into a decline period. So that to contend that this lower for longer may be modified a little bit after, especially Mark's comments, to maybe at least medium for longer, as he said, because we're not going back to $100, but we are going maybe to medium for longer. And then looking at another view, we have a chart here which shows the different resources. The yellow dot there is the Middle East OPEC, where oil is produced, and at capex reinvestments, which are under $5 a barrel. Then you have land conventional, where capex reinvestments are of the order of, say, 10 or 20, above $10 a barrel. And then you have shallow water investments are going up to 20. And then the size of the bubble there shows you the daily production from all those resources. And when we go into a low price scenario as we are in, and we are going to have, let's say, medium price in the coming future, we need to make all of these more efficient, and hence the discussion around cost. How far can technology or innovation take costs down to be able to survive in, let me just keep on using this medium for longer scenario. So here, I want to take Eagle Ford just to make a point. This slide shows you a cluster plot on the left-hand side, which shows the production or the initial production or an indicator of the initial production from all the wells that have been drilled all the way back to 2009. And you see the average remaining more or less the same. And you see that in the lower graph there, that for all of those 5 years, the industry has drilled more and more wells, in the beginning going from 500 to now 4,000 a year in 2014, maintaining a sort of an average initial production per well. And then you see the result of the high grading in the last two bars, that you see a little bit of a rise in 2015. And then on the right-hand side, you see all the technical advancements that have happened, basically in terms of the length of the well, the number of stages, the amount of proppant that is being pumped. And all of this results in getting Eagle Ford going to the way it's going. And you see the drilling costs going down over this period, but then reaching some kind of a level that they cannot go much further down from there. All this to say that nothing has happened in the last 9 or 10 months that have radically changed the view that some technical advancement is going to allow us to produce from Eagle Ford Shale at $45 a barrel, also adding or confirming the remarks made by Mark earlier. So we do feel that at the current price, the production from Eagle Ford will continue dropping as it has been for the last 3 or 4 months. Now, on a worldwide basis, I took this slide from Wood Mackenzie to show that the current expectation on cost deflation is of the order of, say, 25%. We believe that these cost reductions coming from supply chain or labor being reduced or just the offshore rig rates going down, and I'm addressing the whole resource portfolio, we would say that maybe half of the reduction can be achieved from there, but most of the reduction has to be achieved from basically new technical innovations or new ways of doing things. And in addition to that, some change in the industry going to Helge's comments of E&P 2.0, where partnerships are done in a different way, where business realignments or business alignments make sure that operations are better integrated to be able to take out the inefficiencies on the many interfaces that exist in the oil and gas industry today. So if we do go in that direction, we believe that we can achieve cost reductions of the order that are necessary to be able to make a medium price scenario exist for a long period of time. Since I represent Schlumberger, I have to come up to show you some of the new things that are happening out there. One of the interesting aspects that is coming to light, and it addresses both land and offshore, is that we think all of the data and the intelligence that we have from subsurface products and services can be combined with a lot of the surface data that exists, and the whole system together in drilling and in production, if it is tied into an integrated system, can have better, more optimized integrated drilling systems and integrated production systems at the same time. And we see this developing over the next decade quite significantly. More specifically, in land drilling, we think that we can drive this efficiency even faster through a comprehensive drilling system. This is not looking at the drilling efficiency of a well like Kevin talked about, of a rig, sorry, as Kevin talked about. I think we achieve pretty good levels of efficiency in the industry today through automation on the rig, but by combining surface and subsurface, we can go to the extra level of efficiency. Here's a new piece of technology that's been introduced, actually done very well in the North Sea here, where this is a technology where we are looking much deeper into the formation. But more than the measurement that we are making, the interesting thing here is that the data is being transmitted in real time to a cloud-based high-performance computing system, where we are using really serious flops of or gigaflops of power, computing power, to be able to make a real-time computation such that you can place the well in the most productive part of the reservoir. And this has made some of the injection sands in the North Sea commercial today that were not commercial even as recent as 2 years ago or something. So that adds certainly new productivity, but also adds new reserves to a fairly mature basin. Similarly, here's a technology that's been introduced recently for fracking. Again, the idea here is that since the productivity in the system comes from the frac distribution along the well, we space the distribution, or we place the fracs in a much more expedient manner with a technology that actually costs lower for making the completion and then has better productive fracs, eventually actually reducing the cost per barrel. But then again, going back to Mark's comments, these are, at least this one is, let's say it is a significant improvement, but it's an incremental improvement. It doesn't change the scenario of going from medium to low oil prices to develop shale in the future. So with that, I'll make some final remarks. We agree completely, I think, that the supply reaction is imminent, if you like. And then E&P activity today will have to increase if demand remains on forecast to be able to fulfill the demand. And capital, on the other hand, will be uncertain and maybe expensive as well. And supply chain costs will help, but they are not going to be the complete reduction in cost to be able to meet the demand for lower prices. We think that deep water and for unconventional and for some of the other resources, both technical and business innovation will help in the future. with that, I'll turn back to you.
I think with your gray hair, you should make a comment on the future of the workforce, actually.
Yeah, I think on my gray hair, I'm totally of the opinion that a certain amount of crew change in the industry is actually very helpful. Change is always a good thing. And I think the younger people who are coming into the industry, and we hire plenty of them every year, they require new regimes of how to work with technology. And we have to induct some of these people. They're very smart, and they will do much better than many of us have done in the industry in the past.
Thank you. I think given the limited time, I'm going to open this to the floor immediately. So if you have a question, you could hold your hand up and get a microphone. There's one here. Stand up, they might find you quicker.
Is it me?
No, let's do
Or
if
someone
you're
up
ready
there.
at the back, let's do the one at the back here.
Okay. Michelle Foss, University of Texas. I want to thank Mark Papa for providing a very important vote of support for those of us who tend to look at things the same way. 3 questions. First of all, a lot of really good real estate has been getting consumed in the United States, given the amount of activity we've had. So where are EOG and the peers going to go to be able to preserve and expand and sustain portfolios? Second quick question. It's a very light slate, liquid slate that we're producing. And this light oil just can't get the same value as WTI. And we can see this in realized prices back to producers. So how does that factor into things? And then a third quick question, if there's time, for the technology guys. Everybody probably needs to go back and look at data from all of the wells that have been drilled. It would be nice to go back and do some homework on that. And it looks like in some places, recovery rates and other things, results might be better if wells were drilled close to vertical, and maybe shift away back towards that from the longer laterals, resource-intensive laterals.
Mark? Real estate?
Well, the first part of your question related to, there's been a lot of real estate in the United States kind of consumed where the next oil play is going to be. I got that question a lot at EOG. Are there going to be any additional Eagle Fords or Bakken plays or Delaware Basin, Permian Basin oil plays discovered next? And my answer is that I would say it's very unlikely in North America that there's going to be another Eagle Ford or another Bakken oil play found. I think that all the potential shale plays in North America have been scoured and researched pretty thoroughly. So I think the next wave of plays in North America are really going to be just more intensive development, further downspacing, better frac technology, and ultimately some sort of secondary or tertiary recovery in plays like the Eagle Ford, et cetera. But I don't really look to see additional bombshell discoveries made over the next 5 or 10 years of new Eagle Fords or Bakkens in North America.
Was the second part of the question was? I've lost it, Mark.
Yeah, the second part
Light oil, yeah, the slate.
was kind of high-cost plays, or
No, it's the slate of light oil that can't really compete with WTI as a product.
yeah, in terms of the differential
Yeah.
between WTI
Yeah.
and other crudes. I would guess that the differential is going to stay somewhat similar to what it's been relative to other global crudes. I don't see it changing that much in
Yeah.
my opinion there. And I think the third part of the question really related to the technology side for
Kevin,
Ashok.
you have a
So I think the third question was asking whether or not we felt that vertical drilling might supplant long-reach horizontal drilling. I think the issue is still getting as much sand volume in the right place at the right time. And I don't see vertical drilling accomplishing that effectively.
Ashok, you?
Maybe the first part of the question was using all of the data that's available to be able to optimize, let's say, the future exploitation program. And I think that's absolutely correct. And the industry does not do yet as good a job as is possible with modern software technologies to be able to use all the data in near real time, if you like. And all that will change as new systems come on the market.
Okay.
Good morning, Gabriele Ferrazzano from Shell. Technology surely can help to decrease the costs. Do you see technology also a threat in terms of new production coming on stream from few resources holders like big NOCs, where basically they can immediately bring on the market new production in the next future, keeping then the low oil price environment still as is?
I'm not sure. Can you repeat the first part of the question? I'm not sure we got it.
Basically, if technology can be a threat in terms of resources and then production, so new resources brought on the market and then new production coming on stream from existing fields. So like EOR, new technology that we...
Ashok?
Well, you know, I think the industry is always working on new technology, making possible to exploit resources that were not exploitable even a few years ago. We are constantly moving the envelope. You take any of the shale basins, or you take any deep water basin, you take a place like Brazil where Campos was developed first and then Santos pre-salt was developed later, added currently more than 1 million barrels of oil per day, and from a very expensive or a high cost resource. All this goalpost is moving all the time. With that goalpost, with the total capability of the industry, we are only able to produce what we are able to produce. There's no sudden miracle we see where there is going to be an addition, except in the last 5 years, what happened in US shale is, if you want, almost a miracle, where a combination of fast capital and fast application made this thing happen. But this is not going to happen every day, for sure.
And one of the other factors in that is that in the discovery phase of US shale, compared to the discovery phase of an offshore Brazil, there's several orders of magnitude of difference in cost. And therefore you can't, in a deep water Brazil, where actually they've made huge progress with the technology over the last 7 or 8 years, you cannot go at the speed. You need to test it because the consequences of error are so huge cost-wise that you just don't do it.
You know, Andrew, we often get the question as a driller if we think that high efficiency drilling rigs will reduce the need for rigs. Yeah. So in fact, we're kind of putting ourselves out of business with efficiency. And I think we've been driving efficiency on drilling from the very first day of drilling with cable tools, and it's gotten better and better and more efficient and both more time and cost efficient. And our view is that as you continue to drive that efficiency in the drilling and production process, you access more resources. As the world's using up resources, we think it's a good balance. Yeah. We don't think it's a destructive or a competitive threat.
One at the back here, in the middle first, and then we'll go over there.
Hello.
Yes.
We've heard a lot today about, as Peter Hendry from Necton Global, we've heard a lot today about the capital requirements for drilling and new fracking in the States. But I wondered, we've also heard about elasticity as well. Would the panel comment about how easy it will be for existing wells that exist, the pads in place, they drill multiple wells. We've heard Schlumberger saying that they can target and segregate different fracking from the same well in order to increase efficiency. So how quickly, if it is possible at all, can existing wells react to a rise in price to increase productivity in the US?
I'm not particularly sanguine that there's going to be a large burst in productivity due to refracking. You know, I know that there's been a lot of hype about refracking, but generally what we found at EOG is that once you frack the well, particularly a shale well, you set up a certain flow channels in that well where the fracks will preferentially go, and trying to refrac that well just generally will put those same frac into the same place the first frac went. So usually the economics are better to re-drill a well. With the cost of drilling today, it's usually more efficient to drill a well and then put a brand new frac on it as opposed to refracking. So the whole concept, I mean, the two concepts that I think are overweighted are the backlog of DUCs, drilled uncompleted wells. I think that's overweighted, and this concept of refracking. I don't think that those should be given a large weighting as to the fact that they're going to create a burst of production when prices rise.
Ashok?
Maybe just, I'll say that I think the technique that we talk about with broadband sequence is that we have had some success in going into wells, plugging the fracs which are producing, and then putting new fracs in the wells. But this is, I would characterize it as a technology that's worth trying. However, it's not going to change the economics of shale, if you like. And there are oil companies right now which are working with us on trying this out, but it's not going to change everything at all.
I'd add that primary recovery generally creates the highest rate of return. Secondary, tertiary recovery techniques have lower rates of return and attract less capital.
Absolutely.
So you'll need a different class of investor to move into that space if it's ever going to be developed.
That's correct, absolutely.
This question over here.
Mark Linder from Belani. I realize this discussion sort of tends towards light oil, but I wonder what you guys think about the future of extra heavy, and maybe delineate what's, Athabasca type prospects from, say, what's in Venezuela, and what the future holds there.
Well, Kevin is from Calgary. You're lucky. We just noticed it's at the top of the cost curve.
Yeah, it is top of the cost curve, and whether it's surface mining or whether it's SAGD in situ drilling, and we're very active in SAGD drilling. In both cases, industrialization or scale development is really important to try get the economy in place. And it's still, with full-scale mining or full-scale in situ SAGD, it's at the high end of the cost curve. And while short-term price reductions might help that out, long-term it's got to compete with other types of hydrocarbon.
Question? There's one right over here.
Tom Wallen with Energy Intelligence. I, particularly for Mark Papa, does the sort of scenario you're describing for U.S. shale for the rest of this year, for next year, does this indicate that we can look to U.S. shale to be a kind of a swing producer for the oil market, do you think?
Yeah, that's a very good question. It's pretty easy for me to make a guesstimate, a prediction as to what's going to happen over the next 6 months with U.S. shale production. I think that's pretty well preordained that, shale production, in fact, U.S. production is going to tip over and start to decline. The longer term question is if oil stabilizes at a certain price, whether it's $75 a year from now or $80 or whatever that price is, what will happen to U.S. production? My guess is that and this is just a guess, at a $75 oil kind of long-term stable production price for WTI, U.S. production will again continue to grow, but not at a 1.2 million barrel a day year-over-year rate, maybe at half that rate, maybe at 500, 600,000 barrel a day rate. So I guess what I would visualize is a year or two from now, we have $70, $75 oil prices, and U.S. production is growing, but at about half the rate that it's been growing since 2012. And so if you want to call that a swing producer, I'm not sure what the terminology would be, but I do see the U.S. in kind of a long-term growth mode as a producer.
Is it not true as well, Mark, that the longer this goes on, I mean the low price environment, the longer it's going to take to get back to production growth because of the decline?
Exactly, yeah. I mean, my visualization is that if we're wrong and, if these low oil prices prevail for another year or two, then the correction in prices is going to be much more severe,
Right.
because we will be in a global shortfall for oil,
Right.
Clearly.
Andrew, I'm not so certain that high-cost oil that takes a year or two to build production or decline production is a good swing producer. I think spare capacity ends up being the swing producer. But I do think that it's sensitive to the commodity price, so I think that those production rates will come up and come down because it is relatively short cycle when you compare it with the highest cost curve, which is heavy oil, which is a very long cycle investment.
From Repsol. Antonio Merino from Repsol. Just coming again to the role of the U.S. as a swing producer. We are talking about increasing about half of what we have seen in the past. But for how long? Because you were barring any big new discovery in terms of fields, so a new Eagle Ford, a new Bakken. So for how long you will have this half, I would say, swing producer coming from the U.S. As a new role for the U.S.?
Oh, well, I think the U.S. has the capacity with just the shale plays that it has, which are primarily three shale oil plays, obviously the Bakken, Eagle Ford, and then the Permian Basin. I think at the right price signals, the U.S. could grow production at 500,000-600,000 barrel a day year-over-year rate for potentially 7, 8, 9 years. So the U.S. would have the potential to, I don't know if it could become oil produce independent and not have any import necessity, but I mean, potentially they could be moving toward that scenario where we wouldn't even need any imports from Canada with the right price signals. Now, I don't visualize that we will have a stable oil price long enough to have that scenario, because you never have a stable oil price long enough to have that sort of scenario. But we do have the depth of the resource base in the Eagle Ford, the Permian Basin, the Bakken is pretty extensive in my opinion.
One more question. Anybody? Yeah, one here at the back.
Thank you. Thank you for a great discussion. Bringing in climate, so I'm Helge with SP and Statoil. Do you think, Mark, that at the prices you foresee going forward, that there's any room for CO2 being injected in, say, Bakken, Eagle Ford, and the Permian, squeezing out another 3, 4, 5% economically? Could we use CO2 for IOR in the shale plays and going forward? Thank you.
Yeah, I didn't get the last part of that question.
Last part.
If we can use CO2 and inject CO2 to boost recoveries, do you think we can ever do that profitably in shale plays?
If you look at the recovery factors from that we're currently achieving in the shale plays, the best we can say the recovery factors are perhaps 20 to 25%. That is the absolute best that we can say that we're achieving. I would hope that over the next 5, 10, 15 years that we have enough technological advances where we can improve that recovery factor somewhere approaching 40 or 50%, just as we've done in regular sandstone and carbonate reservoirs. And perhaps CO2 is the answer. Perhaps some other sort of miscible solvent is the answer. I don't know what the answer is, but I do believe with this crew change that Andrew and Ashok and Kevin mentioned, that there'll be smarter people than the four of us up here that are going to figure a way to improve recovery factors from shale reservoirs. in the future.
Together with the SPE's 2.0 in E&P, right?
Yeah.
I think that's all we have time for. Thank you all very much for participating.